have money. Welcome to Cramer. My friends, I'm just trying to make a little bit of money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC. Tweet me, Jim Cramer. Look, last night it dawned on me. You can let one stock, in this case, Nvidia, define the entire market, even if you like it as much as I do, or you can let hundreds of stocks be your teachers. Now, on a day where the Dow edged up 47 points, S&P advanced 0.38%, NASDAQ gained 0.59%, we can indeed decide all that matters is Nvidia, which reported would look to be outstanding numbers after the bell. Or how about this? Why don't we try to learn about the entire syllabus of stocks in the rest of the market for a change? So on any given day, there's so many stocks that can make us money. Yet they are devoid, they're forlorn of promotion, of pizzazz. Those stocks matter, though, even if they don't grab headlines like the loved Nvidia. For example, last night we learned that Constellation Energy is getting $1 billion loan from the feds to restart 3 Mile Island, breathing new life into the nuclear plays. So people immediately reach for the most speculative junk imaginable. All sorts of companies that have no hope of turning a profit. They forgot that it is no longer the year of magical investing. But if you've been paying attention, you might have already owned some of the nuclear companies that actually do make you money. Consider the case of GE Vernova. It's building small modular nuclear reactors to provide round-the-clock clean energy. And those reactors don't need no federal government help. GE Vernova, what did it do today? It soared 7%. It was the second best performer in the S&P 500. In part because it also announced its first onshore wind power upgrade agreement outside the U.S. Hey, I got another one. How about a nuclear energy idea that's in the S&P 500 that I know you've never heard of? It's called Solstice Advanced Materials. It's the chemical business that was just spun off by Honeywell at the end of October. Solstice mainly operates in the refrigeration electronics markets, but get this, it has this alternative energy services division that specializes in nuclear. In fact, it's the only American provider of uranium hexafluoride conversion services, which is the crucial step in preparing uranium for enrichment so it can be used as fuel. It's the one to own. Solstice Metropolis Works facility was idled in 2018. Why? Because, of course, there was no demand for nuclear power, but it was just brought back online 2 years ago to help power all these new data centers. The company's backlog was up a quick 12% from the second quarter to the third quarter. I know, you're yawning, you're bored. I don't care. Unlike the hyper-speculative stocks, GE Vernova is the nuke builder, while Solstice is a profitable company with a direct way to make money on nuclear energy. Stock's only up about $2 from its post-spin lows. It's inexpensive. Try that when you buy a lot of that nuclear junk. Or how about all these fintech calls? I got a fintech, how many in the light round? 3 of them each time? No earnings, declining earnings. Well, what's the matter with this? Hey, I got one for you. How about Block, which is the old Square? At an analyst meeting today, Block just announced some aggressive growth targets for the next 3 years, sharply better than expected. Block is a real profitable business, and its stock wasn't far from its low either, aided by a $5 billion announced buyback. This $38 billion stock ultimately vaulted 7.5%. Yes, it was the best performer in the S&P 500. Not bad, just beating out GE Vernova. Now, you know what I'm going to do? I'm going to bring on the CFO. Maybe you ought to learn something about it. Now, I know that many of you can't resist the quantum computing stocks, even after they sold off hard over the past month. Maybe you like to lose money. I'm against that. I would steer clear of the speculative quantum plays because the profitable companies with the best quantum computing technology are actually Alphabet and IBM. You could do worse. Why does all this matter? Simple. I am telling you, you need to go looking for opportunities because an all-powerful stock like Nvidia has started to blind people all over the place. Not me. You know how long I've liked it. As I always say, own Nvidia, don't trade it. So I'm no fair weather friend. Hardly. But it can't be the only thing we focus on. Okay, so obviously Nvidia just reported a terrific quarter with a 5-cent earnings beat off a $1.25 basis, a monster revenue beat. Even better, their AI business crushed the estimates, and management says they're on track to do $65 billion in revenue this quarter. Wall Street was only looking for $62 billion. But what really matters isn't the size of one particular stock. It's the direction. And the direction of the stocks that I've just mentioned is determined by their profits. When we're talking about real businesses, everything comes down to earnings, even if they rarely give you the quick gains that the hyper-speculative names that were so powerful and so good during that era of magical investing. Here's the bottom line. The stocks I mentioned aren't exciting. They're not as interesting as anytime touchdown from Christian McCaffrey or CeeDee Lamb or a 3-team college football parlay or a quantum stock. But they can be a heck of a lot more lucrative long-term, in part because they're much less likely to blow up in your face, and in part because I did the homework for you, and they're real good. River in Texas. River. Perkinalis? I don't know. What do you got, River?
Hey, Jim, this is River from Dallas, Texas. How are you doing?
I am doing well. Thank you, River. How about you?
Hey, thank you for everything. And I really love your book. And
oh, man, you're a gent, River. Thank you.
Yeah. The reason I was calling, I have this stock for almost 2 years now. Verizon, VZ, Communication. I had like 200 shares. What do you think?
I'm going to liberate you from Verizon. Nope, I don't want you. I want you to scale out of Verizon. It does yield 6.7%. But remember, we like growth. Growth is what delivers profits ultimately for us. I'd rather see you in a growth stock like a Solstice, a growth stock like a GE Vernova. These are what I like. And if you don't like those, I would suggest an IBM. But let's stay growth, not just yield. Yield won't get us to where we need to retire. There's a world of stocks outside of my favorite stock in the universe, Nvidia, and the data center stocks. They're not always as exciting, but they can be very lucrative. On Made Money tonight, Williams-Sonoma reported strong earnings and raised bottom line guidance, but investors didn't seem to appreciate the quarter at all. I'm going to get to the bottom of all this with the retailer CEO. Then Palo Alto earnings just crossed the tape. I've got exclusive with the cyber company to learn all about the quarter that people seem to dislike on earnings day and like every other day. And fintech company Block that I just mentioned unveiled these guidance numbers at Investor Day. People loved them. I'm catching up with all the announcements with the company's top brass. We want to be in winners. Stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Hey, what's happening with the stock of Williams-Sonoma? This morning, the furniture and home goods chain, which also owns Pottery Barn and West Elm, reported a solid top and bottom line beat. First, the stock jumped more than 4%. But then it gave back those gains during the conference call when we heard that there might be a significant tariff hit this quarter. Williams-Sonoma ultimately finished in the red. Earlier today, we spoke with Laura Albert, the president and CEO of Williams-Sonoma, to get a better sense of the quarter and what's next. Take a look. Ms. Albert, welcome back to Mad Money.
Hi.
Okay, so Laura, we're going to get to in a moment why the stock, I think, foolishly reversed. But let's talk about what was really, I think, a breakout quarter on so many different lines, including your flagship. The comp stores were much better than anybody expected.
Yeah, we had great success in the third quarter, both on the top line. You know, our focus has been return to growth this year, and I'm so pleased to see all of our brands positive comp, and we have so many exciting initiatives working in our brands. And then on the bottom, believe it or not, we were able to overcome the tariff pressure in Q3, which I don't even think we thought we would do. But you've heard me talk about our 6-point mitigation strategy. The pieces and parts are working extremely well. And, you know, I don't want that to be confused with the tariffs are not affecting us. They certainly are. And in fact, had we not had them, the margin expansion would have been quite great. We're offsetting it in Q3. That was wonderful. And it's really a testament to the team really working together for all the things they've done, especially in supply chain, which we can talk about a little bit if you'd like.
Sure. Well, let's just go tariff for a second. I felt that there were some in the Q&A with the analysts, some belief that more tariffs were a question mark. Now, I saw this happen with Gap. At the last time Gap was on when they said it was a question mark, stock went down ridiculously. It's just been a skyrocket ever since. What I'm betting is that people misinterpreted your cautiousness on tariffs, with meaning that you thought the tariffs were going to go up a lot. And to me, it was just, look, you never know with tariffs. And you even mentioned, hey, China got rolled back. I would like to hear from you that you did not mean danger, but you were just saying, hey, listen, you don't know.
No, let me tell you exactly what I meant.
Okay.
In terms of where the tariffs are going, I think we'll get stability at the end of the year. I hope, and more predictability. And I don't imagine them going up. That is my best guess. Okay. But they are going to affect us more in Q4 than they did in Q3 because a bigger percentage of our inventory is now tariffed as the cost rolls through the balance sheet. And that is what I was saying. I was saying, don't get ahead of us on our guidance and think that we can make up everything in Q4. We've said that our operating margin will be under pressure due to the tariffs. That was my point.
Okay. I mean, I can understand how someone would be skittish, but that to me did not, it was overcompensated for with the stock versus you're gaining share in the industry, you're outperforming the industry, and I've got to tell you, you're doing well without housing, which a lot of other companies have not been able to do.
Right, but let's just, on the tariffs, just say it one more time. The effective tariff rate this year is 30% higher than it was last year. Okay, that's how much we've been able to make up. So I think what people should be really impressed by is the work that we've done to make up for the loss of the margin on the tariffs. Okay,
right.
And we're really excited about that because we're seeing even more opportunity as we go into next year. Because part of our tariff mitigation strategy was supply chain, but we didn't have all of the AI ripping at the same time too. So as we think about next year, and we haven't guided, and we're going to guide in March, we're going to be looking for all the things we can do to make up for the tariffs. By the way, once the tariffs are in the base, which is soon, we're done with this. And you move on and you build from there. So it is a more short-term situation than a long-term.
Well, what are you doing besides the excellent supply chain management? Is there like a grander scheme to make it so that you're immune somehow?
Well, there's no immunity.
Okay.
However, here's what it is. The first thing is resource to the best country you can, the best vendors.
Okay.
We've been doing that. We've been moving things around. We have really cut our reliance on China substantially. We're going to continue to do that. The second thing is renegotiate with our vendors. So our vendors are great partners. They've been giving us better prices. The next thing is our supply chain. Improving our customer service is good for the earnings because we don't have to redeliver. And we have seen a lot of improvements this year, even on top of last year's.
Okay.
And we thought last year was good. This year is even better on that. And then we have our very tight SG&A that we keep looking at and reducing, which will continue to be fueled by AI, even more so next year. And then when you think about our Made in the USA strategy, that is something that a lot of people don't have. We make the majority of our furniture that's upholstered is made in Mississippi and North Carolina. And that is a big advantage because it's higher quality and it's delivered faster and it's free of tariffs. So we're going to be building that. We also are trying some beautiful new product with some USA manufacturers, and we're thrilled to see them off to a decent start on our websites. And then the last thing is we've been carefully increasing prices. So we've been looking at where we are underpriced, and we've taken some price increases. We've also substantially reduced promotions. And that's a really big move that we continue to make quarter after quarter to improve the regular price selling and reduce the promotional percent.
Well, one of my questions was to ask you, how do you keep your momentum without as much discounting when the other guys are discounting the heck out of it?
We have a relentless focus on product, on innovation and exceptional quality and exceptional service. Because when you have a piece of furniture in your house for 5 to 10 years, a little bit of a discount does not matter. So we have to give you the best product there is. And we also want you to trust us, which the customer has shown us that they do, to come to us to learn how to decorate, to make those big decisions for their whole home. And also whether it's, a coffee machine that they have to learn how to make, you'd rather come to us. We will stand behind it. We'll help you use it. And that's very different than a lot of the online players.
Most definitely. Now, one thing that when I look at all the piece on the conference call, there is no doubt that you think that we could have a stronger housing market next year. I'm going to just say you were flat out optimistic. Why?
I am optimistic. I mean, how can it get worse?
Well, don't say that. It can always get worse.
Well, okay. Well, I don't think it's going to. I think that you've got enough green shoots there The desire is there for people to buy houses. And I think we're going to continue to see the customer getting stronger in their willingness to do so. So, especially for our customer at the high end, you're starting to see some better numbers there. It's the beginning. There's a lot of recovery left to do. If I'm wrong, then it's just going to make things a little more challenging for everybody. But we have done a better job than most against the tough backdrop. So you can only imagine what happens if housing picks up.
Excellent.
It'll be a really, really big boom for us.
All right, then the last thing I have to ask you, I did not hear in the call anything about your Agent Force initiative. Is it part of the supply chain a triumph that you exhibited today?
We did talk about it in my prepared remarks. AI is something that's accelerating both our sales, but also our earnings because we're cutting costs. And I believe we're further ahead because of our relationships, but also because of our tech stack and our expertise and our high DTC content. And we are using Agent Force in 60% of our chats, unassisted by humans, higher ratings, faster, accurate. But chats are a small portion of the total customer service. You can only imagine when we move to voice, because chats are online chats typed in. So we have a lot of work left to do to bring voice to Agent Force. And we're already seeing this holiday that we're able to hire a lot less temporary associates. We have cut the amount of temporary associates that we hire over the holidays significantly because of our work with Agent Force. Well, and then also Olive, right, our online culinary assistant, is part of that. And we're finding better ways to use Olive and also to have it drive sales.
Terrific.
This is only one. This is only one piece of our application of AI throughout our company. So there's the service level, there's the online, there's the homepage, there's the emails, there's every contact point, there's the design services, there's the back office, there's supply chain. All these things that we're focused on as competitive advantages are accelerated because of AI.
Excellent. All right. Well, Laura, I think that the stock's going to go higher, not lower. It was just a momentary thing that you just explained everything. You explained everything to our viewers, and that's what I care about. That's Laura Alber, President and CEO of Williams-Sonoma. Go back over her work. She explains what happened today. Thank you, Laura.
Thanks, Jim.
Mad Money's back.
Coming up, Palo Alto Networks is on the move after earnings, and Cramer's got the CEO to break down the cybersecurity's latest numbers. Next.
All right, what do we make of these numbers from Palo Alto Networks, the cybersecurity titan that we own for the Charitable Trust? After the close, these guys reported modest top and bottom line beat. Let's check in with Nikesh Arora, the chairman and CEO of Palo Alto Networks. Mr. Arora, welcome back to Mad Money.
Thank you, Jim. Nice to see you again.
Okay, so Nikesh, I'm not going to get into the why is the stock down nonsense, because I have found that every time it's down, people should just buy it. Let's get a little more granular. I noticed once again that platformization is working tremendously. You have a $100 million large U.S. telco provider. Will that just be everything that they need is Palo Alto?
Not yet. That's just $85 million of that is our XIM product, which I've told you before is our blockbuster product, which is a next generation SIM, and that has helped us cross close to 470 customers from a standing start of 2.5 years ago. So really excited about that.
And a U.S. cabinet agency customer purchased 60,000 seats, and it's Palo Alto's. Yes. That's a gigantic piece of business.
Yes, and actually we replaced one of your other favorite companies from there, and we're able to deploy Palo Alto in the SASE product categories. Really excited about that. Still trying to get myself up in the rankings, and the Jim Cramer likes us more.
I'm glad you mentioned that. There's 499 other companies in the S&P 500 I also like, too. I play no favorites. All right, so let's talk about this acquisition tonight, which is observability, which I now realize is pretty much what you have to have. But this is AI married to observability. Explain why we need this as Palo Alto shareholders.
Well, look, Jim, if you look at what's happening in the world, as we get more and more online, as we get more and more connected, you have applications being used by people on their phones on a constant basis. Anytime that application shuts down, goes down for a minute, that's lost revenue. You want your car hailing app to work. You want your restaurant app to work. To make sure that these things are all working across the entire stack and to find what's broken, you need this product called observability. Every solution that exists in the market right now is 3 times more expensive than what Chronosphere can deliver. That's why many customers don't deploy end-to-end observability, because it's expensive. Even we at Palo Alto used to shut it down because it's too expensive. We used to sample. So now with Chronosphere's capability, they can deliver cost-effective, at-scale observability, which every born in the cloud and every AI model company needs. In fact, they have proven this. They are the partner for one of the large LLMs that you know out there. Mm-hmm. They've basically gone in and replaced the existing vendor. They're slowly transitioning to Chronosphere. This company grew ARR above our expectations from the time we started talking to them to the time we announced the signing of the deal today. So really excited about it. This is a foundational block for any long-term AI capability that you want to build from an application perspective. And this is going to disrupt an industry that's out there called observability.
Wow.
And then we're going to marry that with an agentic platform where you say, okay, now you found it, can you fix it? And you know, AI agents are going to start fixing these things, but to fix it, you need the data. So they have all the data working with the customers. Customers can take that data. We'll do the analytics for them, tell them what's broken, and that capability will then be built into agents to go fix it. So it's really a foundational block in the enterprise from a data perspective. Can't be more excited about this acquisition.
Can you help stop when a hacker is using another company's AI against it? For instance, I thought that this Anthropic AI, people just say, oh, another hack. I thought this was truly scary. I mean, I do not want them hacking Anthropic AI to because that's very powerful. It's like a nuclear weapon.
Well, I think the way to understand is as the attack you're talking about was where AI was used as an assistant to move faster and attack a company. So it's basically like everything was said, well, AI can do this faster for us. Well, AI bad guys, you said, well, AI helped me attack this company. So it went and scanned the company. It went and found the mistakes. It went and said, I'm going to go enter this way. Let me try the other way. Let me try the other way. So all this means is companies need to improve their security stack faster. There is no more time left where bad guys are going to find the stuff faster than you are going to be able to protect it unless you have the right platform to protect it. You cannot solve this problem with 50-point products. You have to have a comprehensive platform. This just plays right into something you and I have been talking about around platformization. Companies need to modernize their security infrastructure yesterday.
Now, when CyberArk closes, or maybe you can do it now, I have to believe that they have some of the biggest banks because the banks can't afford to have their CEO be hacked. Are there any of those large banks that need Palo Alto that you are not in yet?
Well, we can always have more business with every of the banks because many of the banks, do a combination of Palo Alto, some other vendors, and some stitch your own. So, look, I think this is a marathon, not a sprint. We've been able to show that every quarter we're able to get 50 or 60 customers to go put a platform into place. Every time those customers platformize, every 1 or 2 years or 3 years, we go in and expand our base with them from a land and expand perspective. Look, Jim, I'm really excited about where our business is. There is persistent tailwinds from a cybersecurity perspective. Every day there's a new reason why you should go and robustify and modernize your cyber infrastructure. We have validated that we are in pole position in the industry. We're the only ones who can go out and give you a much larger solution. Honestly, half the vendors you can't spend $85 million with because they don't have the product portfolio. So from our perspective, we like the platform strategy, we like the tailwinds that are out there, and we've just gone and planted a flag in 2 new categories called identity and observability. It's kind of like, I was talking to my team and joking, like, this is 2018 for Nikesh. Nikesh is back to the future. I'm going to go make sure that we can go take this business and take it up a few multiples from where it is today in the next 5 years.
Okay, so I always felt Splunk had great observability, and now that was purchased by Cisco. Will you guys be going head-to-head?
We should be replacing every one of their observability customers because that technology was designed many years ago. Chronosphere is 2.5 years old. They built it on a brand new stack that is very AI ready. I don't think some of the legacy products in the industry translate to the new AI stack and what it needs.
Well, I mean, but obviously you would think that everybody, when you buy Splunk, you keep it fresh. I mean, I can't believe that they just let it fallow. Well,
I don't know. I'm not paying attention to them. I'm more focused on where AI goes. That's a good idea.
Okay, about how's that relationship with IBM? Because it looks like that you crushed it with that one. And I know people's eyes glazed over when it was announced, but IBM certainly didn't feel like that. It's been terrific.
Look, we've had a phenomenal partnership with Arvind and his team. We were able to take their QRadar portfolio, modernize that portfolio. We worked together pretty much on every customer of QRadar together, try and get them to the new stack. IBM is, as you know, is very sort of forward-leaning and thinking on the quantum space. And Arvind and I had a long conversation about quantum. That is another area, Jim, where we're going to be hearing more and more in the next few years. As quantum computers get more and more sort of imminent, you're going to find that enterprises are scared that all the cryptographic inventory will need to be figured out. Keys are going to be crackable using quantum compute. In fact, we know there's a strategy called sort of, get the data now and decrypt later. So harvest now, decrypt later. You can collect data today. You can use a quantum computer tomorrow to break that data to see what's in it. So we think quantum becomes the next category where we have to go pay attention to, and there's no better partner than IBM to work on that.
Couldn't agree more.
Together.
They're the way to play quantum, so to speak. Now, last thing, Cloudflare. It kind of happens and goes away, but Cloudflare was a real, I felt, a shield. What did you hear about that one?
Jim, you keep asking me about other companies. I want to tell you how excited I am about Palo Alto Networks, our existing business, our prospects.
It's funny. I like football. And when let's say they're going to play the Cowboys, I ask them, Matt, what do you think of the Cowboys? And they just come right back and they say, I don't care about the Cowboys. We're the Eagles. You're a very shrewd way to be able to analyze other companies. Just keep going back.
My job is to make sure that we make this the best security company in the world. Running Palo Alto Networks is complex enough. Making sure that we serve our customers with best security outcomes is hard enough. I know there's going to be other great cybersecurity companies out there. They will solve problems, and I wish them good luck and Godspeed, and I hope they do well as well, because it's important that our customers get a secure outcome every time.
Nikesh Arora, CEO and Chairman of Palo Alto Networks. Congratulations on a great quarter. How about that?
Thank you, Jim. Okay. It was a good quarter, and I hope we continue to have some more.
All right, everybody's back after the break.
Coming up, Block has been shut out from the market's rally this year. But could its investor day be the catalyst it needs to get going again? Cramer is checking in. Next.
Today we got some great news from Block, the financial technology company formerly known as Square. Today, Block held an Investor Day event where the commentary sent the stock up 7.5%. Let's dig deeper with Amrita Ahuja. She's the CFO and COO of Block. Ms. Ahuja, welcome back to Mad Money.
Thanks so much for having me on, Jim.
Okay, so I'm watching the stock while I'm listening to the presentation, and it just shoots up when you talk about how you could have a 3-year rule of 40 situation. We are big believers in that because what it means, of course, is you've got great growth and profitability. How are you able to pull off and make goals that far out?
Jim, the company that Block is today is very different from the company that we were just 3 years ago when we did our last Investor Day. We are more mature, more disciplined, more focused, and more interconnected than ever across our brands, Square, Cash App, and Afterpay. And you see that coming through in our numbers. We're double the size that we were 3 years ago from a gross profit perspective. We're triple the size from an EBITDA perspective. The momentum and product velocity across our business, we believe, is going to compound further growth ahead. And that's what underpins this strong guidance today. When we look across S&P 500 companies, we see that we're only one of only 24 companies that has the scale, the growth, and the margins that we have. That's rare company, and we want to continue to build upon this progress that we've shown.
All right, let's dig down on that, because when I was examining your company, I was shocked to find you've had remarkable growth. You have 30% compound annual growth since 2020. You're talking about $2.7 billion to more than $10 billion in growth. And I don't get it. What do you think is missing that you had to have an analyst day to tell people about this incredibly inexpensive stock versus the other tech fin stocks?
Well, we think the underlying fundamentals were disconnected from our stock price. That's part of why we upped our stock repurchase authorization by $5 billion today. That's why we're incredibly excited about the momentum that we have exiting this year on a path to Rule of 40, which has been our target for some time. And as we head into 26 and look at the 3 years ahead, compounding this growth with actives growth in the Cash App ecosystem, new volume added, new customers coming in to our Square ecosystem across the US and internationally, increasingly seeing these two brands working together, which really is the differentiation of Block. We sit at the counter in between a consumer with Cash App and a seller with Square. And the power of that, the demand generation that we can create for sellers, the incentives that we can bring to consumers to power our local neighborhoods is the true vision of Block. And that's what we saw on display today.
Well, let's talk about the neighborhood. Let's talk about neighborhoods, because you dropped that, but people should know about this. I thought this was one of the most exciting local initiatives I've heard in a very long time.
What we want to do, what we've always wanted to do, is empower people into the economy, and that includes small and medium-sized businesses. And if you think about the small and medium-sized business, the tools that they have relative to the giant enterprise businesses who have their own apps or who are giving substantial stakes of their revenue to the marketplaces of the world, what Cash App can do in creating a seller profile that then immediately connects to 58 million monthly actives, highly engaged actives within Cash App. And that 1% processing fee for that, so for those sellers, we think that's a really powerful marketplace that we uniquely can create. Now, we're going to start small, as we always do. Hopefully, there's sellers in your own neighborhood that are lit up, and you can touch and feel that product today. But we see that there is a lot more to come with that.
So what would one of the 58 million, you mentioned that's an incredible number of people, what could they get from someone, say, who uses Square as their point of sale? What kind of discount? What are you envisioning here?
So the seller gets a 1% processing fee, which we know is a fraction of what a typical processing fee would be. That's incredibly compelling. What the consumer gets is cash back, local cash back that they can use at any Square seller. Some of that will be funded by us. Some of it will be funded by Square sellers. In our early testing, we've seen incrementality is really strong here. And we also see that when we add more sellers on one side of the ecosystem, that benefits consumers. When we add more consumers, that benefits our sellers. This is the flywheel of the two-sided ecosystem that we're building.
Now, a point of sale has been at times a football business, meaning it's basically someone comes in with a lower price, you might rip out another and take in the new one. How are you able to keep yours sticky?
Our point of sale, ultimately, what we see is retention is strong, and as we grow, more cross-sell. So as customers take more and more of our products on, retention meaningfully increases, and ARPU meaningfully increases. So what we need to be doing is ensuring that our customers understand the full scope of everything we offer, from not just payments and point of sale, but to hardware, software, loyalty, marketing, and financial services products. We know Square Loans and Square Banking products really help these small businesses manage their finances, their cash flows, their working capital. And so the more we can bring that to our sellers, the better. I think ManagerBot that you saw for the first time today, which is building upon Square AI, brings that to life with proactive intelligence and helps our sellers manage their business better. That should lead to stronger retention. That should lead to stronger gross profit for us.
Okay, so let's talk about the Bitcoin element of it. I've always felt that the company itself just is a juggernaut. But when I bring it up, people say, oh, yeah, that's that Bitcoin. They did Bitcoin mining. I would like to be able to say that you have that optionality, but that's not necessarily how you should be looking at the company. Is that fair?
You know, Bitcoin is a long-term thesis for us that the world needs an open protocol for money. If there's a better open protocol for money, we're very open to that. But we think Bitcoin is the leading contender because it is open, it is transparent, it is secure. It's been battle tested for years now. And we believe the world needs and will be a better place with an open protocol for money because it reduces frictions for oftentimes the most disadvantaged. And it enables us as a company to move at the speed of the internet if we look more globally. Now, we start small with everything. We're disciplined and our initiatives are calibrated to the size and scale of the Bitcoin ecosystem today, but we do see a potential growth opportunity here.
But when I think about the company, what I want to think about to me is the Cash App is Square point of sale. It's about the potential of those two together, and it's about the remarkable growth that those have given you that somehow you have not been able to bring out in terms of what investors want until today, of which, look, you're a great spokesperson for the company, and I think it was electric what happened today. But I want to know why it hasn't been electric. And maybe what I should do is just forget that and just think forward. I mean, I do need help here because the story is too good.
Well, we are incredibly excited about the runway ahead, Jim. If we think about the addressable gross profit opportunity, carving everything down to the particular markets we serve, the particular products that we have, that's a $500 billion market. That's $500 billion, and we are 2% penetrated in that market today. We believe we're executing on all cylinders. Our product velocity is accelerating. We've got a leadership team that's bringing that to market in our go-to-market evolution, and we're excited to gain share and to grow even faster than these large markets that we serve.
Well, I think it's interesting that you were the leading performer in the S&P 500 today as people realize maybe this company has a lot more growth than anybody realized. So I say congratulations to you, Amrita, because it was really some fantastic day.
Thank you so much, Jim. I appreciate it.
That's Amrita Ahuja, CFO of Block. The symbol's XYZ.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
Before we start the lightning round, I want to share that we've got a special offer to join the CNBC Investing Club. My latest research and access to the charitable trust portfolio. Simply scan the QR code or go to cnbc.com/Cramer Club to join today. And now it is time. It's time for the light round. Cramer's about rapper quality name. I'm talking to everybody by myself since I'm here. Don't quote at the time. My stamp for subscribers on the fire. Plain and sound. And then the lightning round is over. Are you ready, Ski Dad? Turn the light round. Because it's with Bill in Illinois. Bill.
Yes, first-time caller and long-time fan of your show, Jim. My question is, you're welcome. I hold a nice block of Kenvue stock.
Okay.
Should long-term shareholders be worried?
Okay, it's a really important question because I've been looking at buying Kimberly. I think the answer is no. I think you'll be fine. There's going to be lawsuits. We've dealt with them before. Look at Johnson & Johnson, up 50 when the lawsuits were bad. I think it is a good situation, not a bad one. I'd like to go to Todd in Florida. Todd.
Yes, thanks for taking my call, Jim.
Of course.
The stock I'm interested in is Nebius. And
Okay, Nebius is too speculative for me. It's losing money. Why not just go with Dell? Dell's a terrific company. The stock is down very big. Buy some now, buy some after the earnings, and I think you'll be in terrific shape. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Don't go anywhere. Cramer is getting a read on the state of the private markets with the top brass at Hamilton Lane to see where the sector might be headed in the months ahead. Next.
Well, we know it's been a tough year for the private equity stocks, but because there's too much uncertainty about the economy and where interest rates might be headed. But if you believe the Fed will eventually cut rates, maybe the group can rebound. They do trade, unfortunately, as a group, which brings me to Hamilton Lane. This is an alternative asset manager / consultancy for institutional investors based in the Philly suburbs. It's in Conshohocken. This one's only down about 15% for the year, making it one of the strongest performers in the group. So let's take a closer look with Eric Hirsch. He's the co-CEO of Hamilton Lane. Mr. Hirsch, welcome to Mad Money.
Jim, thrilled to be here.
Well, I'm so glad you're here because I want people to understand that not all these companies are the same. Now, I had Blue Owl on this morning, and they're a totally good, respectable company, but they're under a lot of pressure. And I said to myself, good, I have Hamilton Lane on tonight, and can have them explain what they do, and maybe we shouldn't all lump you guys together.
I think that's the issue right now. The industry needs to be better understood because we are not all birds of the same feather. And so right now, we are more of a solutions provider, manager of managers, We're not a single monoline general partner, which is what I think the market most associates the industry with.
So do you look for a fund that you want to then sell to others, of which in that sense you're a bit of a fund-of-fund manager?
We're a bit of that. We're a bit of a solutions provider where we're leveraging our relationships with all of the private market ecosystem to design products and portfolios for our clients to meet whatever their objectives are in the private markets.
Okay, would they be otherwise able to access the funds that you are accessing for them?
So in some cases, they certainly could. There are very big name firms out there that we're all familiar with. But I think the industry is much, much bigger than that. Today, there's about 6,000 private fund managers all over the globe. And so most individual investors, most institutional investors just don't have the bandwidth to go out and find that deal flow, to assess those managers, and to build portfolios. It's just too big of a landscape.
Now, it does seem that you've got what I call very sticky investors, because they're different from the traditional gigantic institutions. Why don't you tell our viewers about how the mosaic that you have seems very strong in this environment?
So our client base is hugely diversified, ranging from individual investors all the way up to sovereign wealth funds and everything in between. But most of them have made the exact same decision, which is they want Hamilton Lane to handle their private markets portfolio for them. So in that sense, we've essentially been an outsource provider for them. They're not going to try to build what we have, 800 people, 23 offices around the globe. They're just not going to make that investment for a small part of their portfolio. They're going to use us as a partner.
Got it. Now, this morning when I interviewed a Blue Owl executive, it was not clear to me at all that they could necessarily have the liquidity needed if someone wanted their money out. Of course, they said, listen, that's not a concern. But I find it sometimes it's harder if you do a lot of, say, real estate bonds. They're not going to go to 130, 140. I mean, there's only a certain price. There's a bid, there's an ask. What about the liquidity of what you're putting people in? Can they get out if they have to?
So they can get out, but we're also very clear with people. This is a relatively illiquid asset class. Okay. And so we're never selling this to people by saying, hey, it's fully liquid. It's not. These are long-term investments, and we counsel investors, whether they're big or small, to recognize that you should be thinking about this from a longer duration standpoint. Our clients have embraced that. They're thinking about this in 5, 10, 15, 20-year increments. They're not thinking about this on a daily basis.
Now, I looked at the comparable of the competitors. Candidly, I'd not heard of them. I mean, I've heard of Hamilton Lane because I'm from Philadelphia, but you do have a niche that I think that you can dominate. It's not like you're going up every day against Goldman Sachs or JP Morgan.
We're absolutely not. So the number of solutions providers out there is very, very small.
Very few.
It's a much more of a niche business. So again, we're not competing with the 6,000 general partners that are running around. We're not trying to manufacture deal flow. We're leveraging all those relationships. And so for us, it's a much bigger scale business. Jim, we oversee today $1 trillion of assets. That's a big scale business. It's very, very global. It's very diversified. And we're sort of leveraged off of that long-term trend of more money continues to go into the private markets. And we think that's a good thing.
Well, it just seemed like when I looked at your portfolio, I mean, it looks at your business. I mean, it just keeps growing, and it's not really. It has nothing seemingly to do with the Fed, nothing seemingly to do with the up or down of the economy. It's just a growing client base.
That's exactly
and
right.
You make money from them.
We're not tied to that. So changes in interest rates does not impact our business.
Right.
The overall economy, you've seen Hamilton Lane grow in good economic cycles and bad economic cycles. We're much more fundamentally driven around, do investors want exposure to the private markets, and do they believe that Hamilton Lane can be their partner for that?
Well, that's to me a simple message, not some of the convoluted messages I hear that are to me discouraging for individual investors.
This is our Philly roots. Simple.
I like it. Stay that way. That's Eric Hirsch, who's co-CEO of Hamilton Lane, HLNE. And if you're from Philadelphia, this company is a big deal. And if you're not, maybe it should be a big deal anyway. Thank you, Eric.
Pleasure.
I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.